Good afternoon. My name is John, columnist with Bloomberg Opinion, and I am here with my colleague Allison Schrager. She's the author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. I keep tripping over that. I'm so sorry, Allison. And as well as John Lear, chief economist at Morning Consult. We're here to talk Fed Day. We're going to get a Fed decision in about 5 minutes. We really don't expect them to do anything in terms of actually moving the policy rate, but there's a lot of tea leaf reading to be done here. We have our excellent panelists. This meeting comes against the backdrop of what I think I can kind of objectively say has been a really encouraging streak in inflation data. So the market is prepared for something to start happening at some point in the relatively near future. And the question is really about how much and when it all sort of gets started. So John, with that, let me kick it over to you. What are your expectations for today?
Yeah, thanks for that tee up, Jonathan. I don't expect the Fed to make a dramatic pivot today. I do think it's premature at this point to start cutting rates, and I think it's highly unlikely that the Fed will cut rates. I would expect that they sort of slightly mention change in the risk outlook for rates, so highlighting some of the risk of keeping rates elevated for too long. That would be part of that reading of the tea leaves that you mentioned. And then I also would expect them to continue to reiterate their focus on data dependence. At this point, I think we kind of all expect them to be data dependent as opposed to maybe hyper model focused, but still really checking to see how this all shakes out. One thing maybe personally that I think has been really interesting has been just looking at this dynamic between wage growth and price growth and seeing how that has, I think, propelled or fueled the consumer over the last few months. So really kind of thinking about what that means going forward.
Okay. Allison, a similar topic, a comment that got everybody talking in recent weeks was Fed Governor Waller said, we can take our time to make sure we do this right. In other words, the cycle itself. Do you agree? Does the Fed have time at its disposal here?
Yeah, I mean, I reckon so. That doesn't mean they'll use it. I think, as John points out, they want to set expectations that they are committed to inflation. So committed. But it might be time this year at some point, maybe, to, ease up a little bit.
Yeah, that was very well done on the nuance. I think you could be on the board. That was very nicely done. All right. So a couple of items I wanted to mention heading into this that I'll be very curious if they come up at the press conference at 2:30. Number one, the sort of news of the day here, New York Community Bank Corp, a Hicksville, New York-based company with a portfolio of multifamily and other CRE loans, was down at one point today more than 40% after reporting a surprise loan loss provision, and the market is going sort of wild over this. You see a big dip in Treasury yields. John, you think that's the sort of thing that could get these policymakers excited and make them move up their timeline here?
I think it's unlikely. After coming out of the SVB period of uncertainty, there's kind of now even a greater government backstop than there was before. And we pressure tested the reserves and some of the risk management systems of some of the larger banks. And so I think if you're the Fed and you're thinking about what this means for systemic risk to the banking system, it's hard to see this as being worthy of even mentioning.
Yeah, the thing that was interesting here is there does seem to be a tie-in with CRE, which is another sort of generalized area of anxiety for a lot of people in the market. But I do want to switch gears and get just back to the decision itself. So it's hitting and shocked. They stay on hold at a range of 5.25 to 5.5%. So that is that, and I've got some headlines hitting from the statement. So Fed holds the benchmark rate, as I said. Fed can consider quote any adjustments to interest rate. Fed says risks to goals, and this is in quotes, are moving into better balance.
Mhm.
Okay. And Fed, this is a paraphrase, don't see cuts until more confident inflation nearing 2%. When I do get the strike through version of the statement, I will put it up and we'll go into this in a bit more detail. But the takeaway here seems to be, this is a Fed that sees balanced risks. And I do want to dig into this language about the Fed considering, quote, any adjustments to interest rates, because the way that they had framed it in the past, the language had suggested a sort of asymmetry to the possibility of moves. In other words, if they were going to move, they were going to move toward more tightening. Now it seems we're looking at a bit of symmetry, which seems to be the typical trick that Fed policymakers do when they're readying us for the possibility that we can kind of sort of think about the possibility of cuts in the near future. One other thing I did want to point out, I see it's always sort of interesting and a little bit entertaining to look at the knee-jerk reactions in markets to these things, although the first reaction is not always the right one. You do see the S&P 500 coming down a little bit on the back of this nebulous language, and I'll give you a quick check on the 2-year yield. I mean, you talk about confusion. It spiked up immediately, and then it came right back to where it came from, and basically, I don't know. Let's see what Jerome says at at 2:30. So while I while I wait for a little bit more information to come in on this statement, um, let me ask you about the risks, the so-called balance of risks here. So I sort of said, I think the inflation picture is looking pretty great. And where does that come from? It comes from the fact that personal consumption expenditures, core deflator, that the Fed likes to focus on, 2.9% year on year. That's pretty great, pretty close to the 2% target. If you take the 6-month annualized rate, it's at 1.9%. You're already at target, right? So the numbers themselves today feel pretty good. However, you've got some things going on over in the Red Sea, maybe some changes, some challenges to shipping prices could feed through to goods prices. Is that a concern for you, John?
I think the broader goods landscape is a concern. We've benefited so much from falling goods prices and from an easing of supply disruptions. And so I think a lot of that heavy lifting is done already, and it's going to be more and more difficult. I shouldn't say the heavy lifting. The easy part is kind of done. We had the supply bottlenecks ease. So then there's a question of, well, how much more goods disinflation can we get? And when you move over from the goods to services, you're seeing, I think, not quite as rosy of a picture as you outlined, which is a little bit more stagnation on the services front. So then there's kind of a question, you go through the items that make up PCE, and you try to figure out, well, where's this disinflation going to come from going forward? And I think that becomes a harder game.
Okay. I want to put up the statement real quick to just get into this, so here's the long and the short of it. I want to go straight to the third paragraph of the statement. And the first thing I want you to notice is this is showing where the changes were made to the statement. Typically, monetary policy makers are take any changes to this statement very, very gingerly, but there's a lot of red strike through on this piece of paper, and there's a lot of new blue language. So in the old statement, the committee used to say the committee will take into account cumulative tightening of monetary policy, the lags with monetary policy affects economic activity and inflation, and economic financial developments. And that's in determining the extent of any additional policy firming. So again, like the way we were set up with the language that we had previously in the statement, it was basically like saying, if we're going to do anything, we're going to tighten. It was more nuanced than that if you listen to Fed speakers in their actual speeches, but this is the official policy statement, and that was how they were set up. Today, we get this bit in blue that I'm now highlighting with my cursor, which replaces that old language and says, in considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. It will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. So to put a bow on all of that, we have moved from a tightening bias to a neutral bias. We have not moved from a tightening bias to a cutting bias. And this is a Fed that likes to think of pivoting, so to speak, as like are at the beginning of like a very slow turn. And to me, I don't know if you guys read this the same way, but like I see in this language, I see a lot of language of caution, much like John was describing. I see policymakers that are still concerned about upside risks to inflation. And it feels like, based only on this, having not heard the way Jay Powell is going to sound at the press conference at 2:30, it feels like this process may yet take a little while. What do you think, Allison? You with me?
Yeah,
you buying my shtick?
Yeah, I mean, this is not a Fed that likes any surprises to markets. So I think that's in there. And I really think they want to see another inflation report before they make any decisions, because, last time it didn't, like, inflation, maybe it has stalled. Maybe this last mile is going to be the hardest, or maybe it was just, housing, which is about to come down. Or maybe there's only so much kick from sort of prices falling in the goods sector, and that's about to reverse for the Red Sea. So I think, they will have more information with the next inflation report about whether or not their progress is stalling, in which case that maybe they'll wait, another several months, or maybe they're going to see continuing downward trend in inflation, and they're going to start, next time say, well, pivot even further and say, we're really looking towards cutting.
Fair enough. So they're always sort of balancing two things. They have this dual mandate, right? Stable prices and full employment, right? And my story is the inflation picture looks pretty good, but we've outlined some clear risks here. The other side of the equation is like, how serious are the risks to the economy itself? On the one hand, I can tell a pretty optimistic story, right? I mean, that fourth quarter GDP number was fantastic. It followed a fantastic number in the third quarter. The holding up. And John, we think Morning Consult, and we think, consumer confidence, consumer sentiment, confidence feels like it's really coming back, and maybe that becomes a virtuous cycle for this economy too. So how are you thinking about the real growth and the full employment part of the picture here?
Yeah, well, I mean, consumers are definitely benefiting right now from a period of, of headline inflation falling faster than wage growth, and so you had positive real wages really for the last 6 months. That has driven, you can see the White House came out with an analysis of this recently, roughly $1,400 for the median consumer relative to their 2019 basket of purchases. So they've got a little bit of money stashed away, or they can devote it to spending. We've seen that in our own personal finances data. It's driving up consumer sentiment among that higher income group the most, because they are most likely to have exposure to the stock market, which has been on a real tear. And I think that's maybe, just to bring it full circle, that's kind of the messaging that I would expect to see from Powell, is just to really level set here, because I towards the end of December, early January, markets really got out over their skis. And so it's like, can we walk this back a little bit and highlight what a gradual process is going to look like? And can we do that in a way that maybe limits some of the volatility in markets that doesn't help? It's going to be a challenge. It's not going to be easy. I mean, just to be clear. And then on top of that, they've basically committed themselves to being data dependent. So it's really, really difficult to know for sure what the future looks like when you've got to, check in on these data updates at every time. And by the time the picture has changed, again, if you take that tanker analogy, it's very difficult to move a tanker when you're already at the finish line. And so I think that's it's a challenge of the positions, the nature of what they signed up for. It's a hard job.
Yeah. How would you deal with those challenges if you were Jay at 2:30, Allison? Like, what if you're Jay? What is the main takeaway that you want markets to walk away with?
I would not. I mean, I think markets are already pricing in a bunch of rate cuts this year, which I think might be a little optimistic on their part. So if I were him, as I said, he doesn't feel like he's close to the finish line, but not quite there. If I were him, I'd be like trying to sort of tamp down a bit on those expectations, but also give them room to think that maybe rate cuts are coming, but like don't expect whatever 4 rate cuts that you're pricing in this year, or whatever they're doing, because markets effectively are like have already declared victory and are moving on, and they might be a little premature. And so I think he's going to try to sort of tamp that down, but also give them a little bit of hope all at once.
Right. Fair enough. My take has sort of been like don't expect him to push back that much on market pricing. You're right. At one point, the futures market was implying, something like 6, and at one point nearly 7 cuts in 2024, which just seemed implausible, given you have 8 meetings in a year, right? And like stuff comes up that makes the Fed want to, sit around and watch the developments for a little while. They're not going to go like bang, 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 and do it just like that. But I thought, like, sort of reading the tea leaves of the market itself, that would kind of rectify itself. And my rationale was basically the following. So like the futures market reflecting like an average expectation, and that average is dragged down by like the hedgers and other market types who still have these bets that they're basically going to cut to zero in like a recession or something like that. My interpretation was that like the modal expectation in like options markets or something like that is still a more reasonable, like maybe 4 cuts or something like that. So my thought is that as soft landing hopefully becomes more and more of a base case, and you see like the hedgers, on return to the zero bound get taken out of the equation, that you would sort of naturally see bond yields even drift up a little bit in the sort of near to medium term. So that for me was my story for why Jay didn't really need to push back that much in these circumstances. I don't know if you buy it or not. Feel free to jump in and push back. But another sort of general question that I have for both of you, I guess I'll start with John, is there a risk in tying their hands too much? Like, it really felt like in 2021, they tied their own hands with their own forward guidance, and that was what kept them from getting rates off of the floor. It's what kept them from stopping QE when they really should have, when inflation was really already there in front of our own eyes in the data. And you don't want them to make the opposite error at this juncture. So, yeah, like, why tie your hands in any way, shape, or form, right?
I think what I would say is, forward guidance is valuable insofar as it's credible, and given again their prior commitment to data dependency, it's hard to think that they would necessarily follow through with forward guidance regardless of what they see in the data. And I think, you got to try to characterize how are these decisions made. And it does feel, at least, I take them at their word, that they really are evaluating developments in the economy from meeting to meeting. And so if that's the case, then the forward guidance becomes less valuable. And you really need to look at the data and understand sort of how Fed policymakers are going to interpret different macro data releases.
So it's an interesting point, because it's almost like saying 2021 might have just killed that as a policy objective. Because if you're saying, well, we'll cut or raise rates based on what the data does, then what's the point of forward guidance? Like, that's always true. The whole idea I always felt like with forward guidance, which honestly I was never a big fan of, because I always thought it was sort of had this flaw, like, well, we want to commit to something, but we also want to retain some discretion. So we're just going to commit to something in the future so we can do discretion now, which is always just silly. So I feel like if they're just saying, well, we're just going to see what the data says and then go with that, then, that's not forward guidance. That's just always true.
I also wonder, you don't hear a lot about this, but they went through a pretty major policy review right before the pandemic and sort of shifted a little bit to focus more on average inflation as opposed to a point in time. And so the idea was, to some extent, if inflation is above our target for a while, we need it to be below our target for a while as well. And I think that the timing really could not have been any worse, which is to have a new policy framework come into play at the same time as you have a pandemic and everyone's trying to figure out how to interpret Fed speak. But we're going through right now really potentially the first tightening cycle post Principles 2.0, Framework 2.0. And how exactly are they going to interpret a framework that gives you a little bit of wiggle room? Because there's a world out there where they say, not only do we need inflation back down to 2%, but we got to make up for lost time.
Fair enough. So let me kick over to you guys a sort of broad macro question. The question is always, it's fun to quibble about, like, oh, when are we going to get the first cut? Are they going to do 25 or 50? Are we going to get 4 cuts this year or 5 cuts? But the sort of big question here is where do we end up? What's our landing spot? And my question for you is, having seen the extraordinary strength of the economy in the third quarter and the fourth quarter, having seen what has been implicitly pretty impressive productivity growth, and having done all of this at 5.5% Fed funds, do we really still think 2.5 nominal is the neutral rate, and therefore sort of the landing spot?
I'm of two minds. On the one hand, I think there's structural changes to the economy that do mean, independent of the pandemic, or maybe the pandemic accelerated them, that brought us to a higher neutral rate. On the other hand, I think Fed, the sort of monetary policy and the impacts of it in the last couple of years was sort of not typical. I think the pandemic aspects of the pandemic economy were really weird. I think normally if you increase rates that much, it would have an impact on the labor market. It didn't this time. I don't think we should assume that's the new normal by any stretch. I think just the post-pandemic labor market was just weird. It was just stronger than Fed rate increases. So the Fed could increase interest rates that high and not have a big impact on the labor market. So I wouldn't take, any post-pandemic thing as an indication of a higher R star. On the other hand, I think they should be thinking more carefully about the fact that there are structural reasons to think we are in a higher R star environment, like demographic changes or, trade differences or all those sorts of fun things.
Yeah, I second Allison's general caution. My sense is that there will be decades of people writing papers quibbling over both R star and also sort of the impact of monetary policy on labor market outcomes, and doing some probably sophisticated econometric work to parse out that causality. It's not clear to me, or I shouldn't say it's not clear to me, but while the Fed has raised rates pretty aggressively, it took them a while to get to something resembling, contractionary. And so I think that's part of it too, is that inflation was so high that they really had to get rates up quite high to get positive real rates. And I think that's probably the picture going forward, is that even as they keep rates steady right now, the real rates are effectively going to be tightened. And I think coming out of the really blockbuster Q4 GDP release, that makes some sense.
For sure. What about the future of quantitative tightening? Of course, the Fed has had this program of balance sheet roll off. They are, to use the jargon, sort of passively shrinking their balance sheet. Right, bonds mature and they don't roll them over. And slow process. It has been mercifully a process that has gone on in the background, but we're always worried, like, will it come into the foreground 3 months from now? Will it come into the foreground 6 months from now? And there have reasonably been some people, myself included, who have said, yeah, it's maybe not a bad idea to not push our luck and think about doing a bit of tapering there. Do you agree with that? Is there any concern in your mind that that QT might be pushing it, at least at the current pace of roll-off, John?
Oh, sorry. I just want to be clear. So you mean that they would start buying longer-term bonds again?
Well, I mean that they would reduce the amount of monthly roll-off of treasuries and mortgage-backed securities.
Sorry, how would they do that?
So yes, they would have they would ostensibly be rolling over more bonds.
Yeah, this is to me an issue. I just don't see it as being really appropriate in this world where we have inflation where it is, right? This was really a tool designed to fight the effective lower bound. Doesn't feel like we're in that world, or we're going to be in that world. And so I think you can give up this kind of degree of freedom and not lose too much.
Also, I mean, one of my colleagues, Manasseh, pointed out that to some degree, this is being tempered somewhat by the Treasury's decision to issue fewer coupon bonds. So, I mean, that sort of as well, like, changes the mix and, makes the impact of QT a little less strong. And, that might be preferable to the Fed's always buying bonds to keep. It's you're sort of starting to veer into monetizing debt if you make this a regular thing just to sort of control interest rates when you're not in a QE is supposed to be like, there's an economic emergency going on, not we want to manage our debt costs.
All right. Fair enough. let me take it over to uh, to politics for a sec, which is always a little bit perilous. But John, I wanted to ask you sort of what insights you had for us at this juncture about how the economy is playing in the political sphere, and how we should be thinking about that heading uh, into the election here.
I think one of the big takeaways has been that this period of pretty strong and robust positive real wage growth among consumers, it took a while for them to actually update their views of their personal finances and of the broader sort of macro outlook. And that was a real question for a while, which is, it took different forms, but essentially the economy is on a tear. Why do consumers say the economy is terrible? It's some version of that kind of basic question. And I think at least one answer is, well, it took them a while to appreciate that their savings were, they were gradually replenishing their savings, and that while inflation is terrible and does a lot to erode the purchasing power of Americans, a strong labor market does a lot to help them. So that's sort of the broadest picture of where consumers are. Not where they don't have a view as rosy of the macroeconomy as they did prior to the start of the pandemic. So back, let's say January of 2020, but they have dug themselves back out of the hole that started mid 2022, Ukraine war, and then record high or near record high inflation. So I think it actually, on the political front, it's evolving very rapidly, and I think it looks more optimistic than it did even a month ago.
Okay, gotcha. Allison, has your interpretation of like what's been going on with the Vibe session and all of this changed in recent months? Feels good that I mean, like we spent months and months having this debate, and now it sort of feels like it's a little bit moot, and it doesn't matter. But like, what is the big takeaway after all of this?
Yeah.
Why was confidence in the dumpster for so long?
Well, I guess I'm also data dependent, and I guess the turn in consumer sentiment has made me feel like the Vibe session is almost over. So, but I think people underestimate how bad inflation is for people. And even when inflation was coming down, it wasn't coming down evenly. And I think what people sometimes don't realize is that what inflation does is it introduces uncertainty in every purchase. So if you think a variable asset, all else being equal, is worth less than a fixed asset, then like you've just made everyone's income a variable asset. So even though as inflation is coming down, you have prices moving around. And so you have this uncertainty. And I think people really dislike that, and for good reason, particularly if they feel like, they're living paycheck to paycheck, eggs being $7, that's a big deal. So I think there was some trauma with that, especially because people hadn't experienced such a thing in a long time. And also, as I said, the risk and uncertainty involved. But I think finally they've had several months of that not being true. And so people are getting more optimistic.
Yeah, sure. John, can you help settle something for me? So, there's this aspect of the consumer sentiment, consumer confidence numbers that like, you look under the hood at what Democrats say about the economy and what Republicans say about the economy, and it's clear that there's a massive partisan gulf, right? And yet at the same time, some people will say, to an extent, the partisan gulf has always existed, and it's always sort of canceled each other out. So that doesn't mean don't look at consumer confidence or consumer sentiment at all. But is that, I mean, has there been a, sort of a meaningful secular increase in partisanship seeping into these numbers over the years and decades? And like, how should we interpret them in light of this, if it is a thing?
I mean, that's the work of Atif Mian and others at Princeton to dive into a lot of that work and highlight growing partisanship in some of the sentiment data in the 1990s, what we see in our data is that divide between Republicans and Democrats on a daily basis, that's a pretty constant number. The difference is roughly 40 points. It alternates following an election, but when you trim the two series and put them on top of each other, they're basically on top of each other. So in other words, they're interpreting economic developments very, very similarly, almost identically, albeit from different baselines. And it's also the case that their views of their personal finances, kind of the micro picture, is much closer than it is of the macro picture, their views of broader business conditions and business expectations. And so I think my response, which is maybe a little nuanced, which is like, well, what are you trying to do with the data exactly? And if the answer is, I'm trying to understand the strength of the economy, then I would say, well, probably you should be looking at some version of a change over time anyway, in which case you're going to abstract from a lot of that partisanship. Now, if you're trying to figure out, who's going to win an election based on their views of the economy, then I think it's a different story, and the level can be really informative.
All right. Well, we have Jerome Powell at the microphone there now, so I'm going to leave it right there. But thank you very much to John Lear of Morning Consult, Allison Schrager of Bloomberg Opinion, Manhattan Institute, and other places. And thank you all for listening in. Have a great afternoon.